What is an economic shock in macroeconomics? Imagine waking up to a sudden storm that disrupts everything in its path. That's similar to what an economic shock does to a country's economy. It's a quick, unexpected event that shakes up the entire economic system. These shocks usually come from outside the normal flow of economic activity, meaning they are exogenous. They can cause big changes in things like how much stuff is produced, how many people are working, or how much prices are rising. Sometimes they are positive, like a new technology that boosts productivity. Other times they are negative, like a natural disaster or a sudden spike in oil prices that makes everything more expensive. Economic shocks happen quickly and don't give the economy much time to prepare. They hit suddenly and tend to be short-term, but their effects can last longer. These shocks impact the whole economy, not just one industry or region. They can change the balance of supply and demand across the board. For example, a financial crisis can cause a sharp drop in consumer confidence, leading to less spending and a slowdown in economic growth. Or a natural disaster can wipe out factories, reducing the supply of goods and pushing prices higher. There are mainly two types of shocks. Demand-side shocks change how much people and businesses want to buy or sell. For instance, if consumers suddenly lose confidence and cut back on spending, that's a demand shock. It can lead to a recession if spending drops enough. On the other hand, supply-side shocks affect how much stuff can be produced. A sudden increase in oil prices makes transportation and manufacturing more expensive, reducing supply. Or a technological breakthrough can make production cheaper and easier, boosting supply. In terms of business cycles and economic dynamics, these shocks can push the economy into expansion or recession. When demand rises suddenly, it can cause an economic boom. When demand falls or supply is disrupted, it can lead to a downturn. Governments and central banks respond to these shocks with policies. They might lower interest rates to encourage borrowing and spending, or increase government spending to support the economy. Sometimes they try to improve supply flexibility or devalue the currency to help exports. Understanding economic shocks helps us see why economies fluctuate and how policymakers try to keep things stable. These shocks reminded us that the economy is always changing, sometimes in ways we don't expect. Recognizing the causes and effects of these shocks helps in designing better responses to keep the economy healthy and growing.